Hi everyone, this is Sandeep Anand. If you are an aspiring investor in the stock market or an aspiring entrepreneur, I have very bad news to share for all of us. It's just that human brains are not wired to think long term. Blame it on our evolution days to the caveman days harkens back, where it was a fight or flight response when we see a tiger. Our ancestors used to either fight or flight. That mode is the short term thinking I'm referring to. And this natural wiring of human brains towards short term thinking is a real dampener on somebody who's trying to become a successful long term investor or successful entrepreneur, because both of that needs a long runway, long term planning, and long term execution, and persevere in that long runway. So let me explain with couple of real life example how it feels, when with couple of real life stock examples, and how to overcome this short term thinking bias, and explains with some history and story narrating why this happens. And with I leave you with couple of videos in the end, so stay till the end, from the two most powerful or successful entrepreneur and investor in the world, which is Jeff Bezos and Warren Buffett. Let's take the case in point, which is the Tesla stock, a clear winner, leader of the electric vehicle renewable energy space, and it has been a clear win in the last couple of years. Now here is a chart in front of you. Now you see in the chart, Tesla stock price was, this is a 3 month chart by the by. And I want to really, show that this is a short-term thinking process, right? So it's on Feb 10, 2020 till May 10, 2020. You see the chart. It shows really the Tesla stock was trading at $183 roughly in Feb 10, 2020. From this point onwards, the stock price fell by 60% when the global markets crashed during the pandemic, and it fell by 60% to $72 from $180. Imagine if you are holding this Tesla stock, 15% of your portfolio, for example. If you're holding Tesla stock and it falls 60%, the pain it goes through. But good part is from that point, the market retraced back and Tesla stock retraced back to its original value almost by end of May. So this is a 3 month period, short-term view, where you had to go through the pain as well as a relief factor when it retraced back. Now this is a short-term thinking. Hold this thought. Now let's look at the long-term view here, right? So here you can see that the Tesla stock price over last 5 year period, right? You can see that it has fallen 30% over last 5 years, 50% once, 60% once. So this is the 60% fall I had shown you in the previous slide. So this is a small part of this long-term chart, which you went through that pain and a relief factor. But look at the overall, in the long-term view of this chart, this small period doesn't make a big difference in your life. Rather, it was a great time to buy Tesla stock heavily if you had believed in the story. If you had a long-term view and you had bought it at $72, the stock went up 9 to 10 times. Take this, it went up 9 to 10 times till date. Of course, it has corrected after that, but that's the long-term thinking process. Now, I also want to show you another example, one more short-term expanded view of this period, which is this one right here. You can see this valley. So this period I'm going to expand into a larger chart so that you understand what again the short-term period, short-term thinking can cost to us. Now, this is that expanded view of the chart. Previously, I just showed you in that peak. That peak was around $900 when the stock price doubled from October all the way up to 900 from 400. And people would have loved it when the prices only went up and it doubled. But it hovered around in that range of 900 and 800, and it then fell recently. That's the fall I showed in the previous slide, 35% to 563. And it fell even further and it corrected in hovering in that range now. So people don't like the near-term volatility and corrections. That's a short-term pain that is causing us to sell the stock when it falls down. This is a very interesting book. In 2004, it got published, which is called A Short History of Progress. The author, Ronald Wright, describes human brain as something like a software of 21st century running on 50,000-year-old hardware. It's so true because human brains evolved to short-term thinking from the caveman days, And it's supposed to be like, when the caveman sees a tiger, it's a fight or flight reflex, which is nothing but which triggered by the short-term instincts of human beings from the days of survival. And long-term investing is exact opposite of these short-term instincts. This is why human beings are not naturally wired for long-term thinking and long-term investing. Now, why do we value immediate rewards or instant rewards over the long-term rewards? Even when the short-term rewards are smaller in value or lesser in amount than long-term rewards, we tend to lean towards the short-term rewards. The reason for our reluctance to think long-term has to do with something called, it's a bias, behavioral bias, called hyperbolic discounting. The word sounds scary, but in very simple terms, it is what behavioral scientists found that humans consistently will tend to or lean to opt for immediate rewards or instant rewards instead of rewards down the years, even if the latter or the rewards in the long term are much higher. Now here is a Dilbert cartoon where it shows, do you need $100 now or $500 after 5 years? So best example, his answer is, oh, that's easy, I'll take the $100 now. That is hyperbolic discounting, to put it in a very simple way. Now, let me leave you with two great videos, as I promised in the beginning, of Jeff Bezos and Warren Buffett speaking about the power of long term thinking, how it leads to success. And do subscribe this video and wait till the end to watch this video. Hope this will be helpful. Thanks. Signing off, Sandeep, Anand.
It's that approach of buying businesses. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, "Look, my brother just died, and he owned 20% of the business, and I want somebody to go in with me to buy that 20%. And the price looks a little high, maybe, but this is what I think I can get for it. Do you want to buy in?" I think if you like the business and you like the person who's coming to you and the price sounds reasonable, and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. It won't be quoted tomorrow or next week or next month.
Is that we are willing, I would say even eager, to invent and pioneer. So that is, I think that goes along, it marries really well with customer obsession. Customers are always dissatisfied. Even when they don't know it, even when they think they're happy, they actually do want a better way, and they just don't know yet what that should be. And that's why I always warn people, customer obsession is not just listening to customers. Customer obsession is also inventing on their behalf, because it's not their job to invent for themselves. And so you need to be an inventor and a pioneer. And the third one, that's really central to the way we think about all of our business problems and a bunch of things at Amazon, is we're long-term oriented. So I ask everybody to not think in 2 to 3 year time frames, but to think in 5 to 7 year time frames, to not think about, when somebody says to me, congratulates Amazon on a good quarter, which is a very common thing to say. You meet somebody, they're being nice, they looked at your financial results for the quarter, they're like, good quarter. I say thank you. But what I'm thinking to myself is, that quarter, those quarterly results were actually pretty much fully baked about 3 years ago.